along, ladies and gentlemen. I'm Hira Gatia. We have with us Mr. Dhiraj Nayyar, Chief Economist at Vedanta, former head Economics, Finance and Commerce, Niti Aayog, joining in. Welcome to the show, Dhiraj, and always a pleasure to speak to you and get insights from you. Dhiraj, one major concern that majority of the economies are grappling with right now is what's happening on the inflation front. What's your read and what's the cascading effect that we could see on the Indian economy, especially from Europe as well as the US?
Yeah, well, obviously the data tells us that something extraordinary is happening, particularly in the advanced economies. US and Europe in particular are seeing inflation levels at between 7 and 9%, which is something which has not happened in those economies in 40 years. So clearly, an extraordinary turn of events. But we know why it is so, partly because of the huge stimuluses and liquidity that was injected post-COVID. And now, immediately as you are recovering from COVID, you have this Russia-Ukraine war, which is obviously putting pressure on key things like food and fuel, which are basically fundamental to inflation anywhere in the world. So we know why it's happening, but at that same level, it's unprecedented. And for India, we are always vulnerable, especially on fuel, because we import, 90% of our, almost 90% of our requirements. So, anytime it reaches, $70, $80 mark, and now it's over 100, that obviously causes concern to inflation, current account deficit, the value of the rupee. So a whole lot of macroeconomic statistics go into the, red zone, so to speak. So I think in that sense, obviously, it's a matter of concern. But if you compare where we are in India, inflation is actually not so runaway. I mean, by Indian standards, 7 to 8%. CPI is not, like 7 to 8% in the West. Because in the West, as I said, you're not used to more than 2 or 3%. That said, we have to be careful because WPI is at, much higher level, let's say 15, and the pressures are there. And, once expectations build in, that causes problems. So we have to be careful, but I wouldn't say we are in a, panic or situation right now. The government has done the right thing by cutting, taxes on fuel, because fuel, again, is fundamentally food and fuel are what are feeding the inflation into the rest of the economy. So if we can, government still has room, it can even cut taxes further, but then that puts a different kind of pressure on the fisc. As we know, a lot of them, fisc is being supported by taxes on fuel. So there are trade-offs, but I think at the moment we are not in as bad a space as we might think we are, or we might have found ourselves in, given the global scenario.
Right. So overall, a lot of economists are predicting that the US could slip into recession in the near term because of the rising inflation. If that does happen, how do you see it impacting our country?
Ironically, if there is a recession in the US and in China, there's already a sharp slowdown because of this hard line they've taken on zero COVID. Ironically, that may actually put the inflation pressure down a little bit. So it's not great news for growth, obviously, if major economies in the world are slowing down or in recession, but it may cool off the inflation pressure, and sooner than might otherwise happen. In that sense, it may be good news for India, because if oil prices cool off a little, as general inflationary pressures cool off a little, the requirement of extreme hikes in interest rate will not be there. The extreme possibility of recession may not be there. So I think if, as I said, it's paradoxical, but perhaps the US going into recession and China slowing down may actually help us from the inflation point of view. And I think that is our big concern right now.
Right. And in terms of growth as well, how are you seeing it? Because, clearly recently you had the RBI monetary policy as well. And clearly, we are on the trajectory of increasing rates. Now, with all of that said and done, how do you see the rate increase cycle taking the growth aspect into consideration?
So I think, obviously, the rates are going to go up. I mean, that goes without saying, and I don't think there's any getting away with it. But in India, unlike in the West, again, the commentary in India often tends to, copy the West. Now, in the West, the traditional levers for government are monetary policy and fiscal policy, and post-pandemic and the war, both those are limited in terms of what they can do for growth in those countries, because you don't really have fiscal space. Interest rates have to go up. In India as well, interest rates will go up and, fiscal space is not great. But, we have a third lever here, which is structural reform. I think there's still that lever which the government has, done a number of structural reforms through COVID, and they can still do more, including a more aggressive disinvestment privatization program. So in India, the sources of growth beyond, or the levers of policy extend beyond just monetary and fiscal in terms of boosting growth. And, the world's still in the mood to diversify supply chains, with the energy transition underway, many sunrise sectors coming up. I think the growth opportunities for India are there beyond, what the fiscal and monetary policies can do. So I understand that those are constrained in terms of being able to promote growth at this point. But I think the structural levers and our natural positioning as still a relatively fast-growing economy and as a place where you can diversify supply chains too, will still work to our advantage and help us sustain growth even through this cycle.
Right. So overall, if you see between April to June, MPC has raised policy rates by almost 90 basis points. However, if you see at the same period, the RBI's projection of inflation for the year 22-23 has almost risen by 100 basis points from a 5.7% to a 6.7%. So in totality, if you see the real policy rate, that actually remains more or less where it was in April, implying that more rate hikes are needed to get the real policy rate in the positive zone. If that is the situation, what is that quantum we should be looking at?
So I don't think it's necessary, to look at real rates being in the positive zone, for the simple reason that if you look at the demand side indicators in India, now I'm talking about, consumption is still fairly subdued, investment is fairly subdued. So, you don't have a situation of runaway demand, aggregate demand, which requires cooling off, which is what interest rates will do, which is what interest rates are supposed to do. So, but at the same time, I think what the role of interest rates right now is more in terms of anchoring expectations, because inflation is a function of what is actually happening to prices and what people expect will happen to prices. So I think it's more a matter of anchoring expectations more than cooling down demand, because demand is anyway quite cool. It's not exactly overheating. So you have to be a little careful. You don't want to raise rates so much into the positive, real rates into the positive zone, that the demand collapses and growth suffers as a result. So it's a delicate game the RBI and the MPC have to play. So I think, of course, it will go up by, at least another 100 basis points, I suspect, over the coming months. But I don't think you necessarily need to reach to a situation, where you have to do a very dramatic hike. In fact, if you look at the minutes of the MPC and what one of the deputy governors, Michael Patra, who's the deputy governor in charge of economic policy, expects inflation in FY24 to be around 4%. So he's not expecting this inflation to be long lasting. If it's a supply side inflation, things may cool down sooner, in which case the RBI doesn't need to do an overkill. I mean, I understand they need to react, but they don't need to do an overkill, because, demand as such is not overheated.
Right. And with all of this said and done, what's your view in terms of the current account deficit as well? Where do you see it moving?
So, fortunately, again, what one engine of the economy which is doing well is exports. So normally, for the last 4 or 5 years, we had been complaining that exports are not doing, as well as they should. But now, for a number of factors, including domestic reform, including global commodity prices, we're doing better on exports. So that in a way helps cover any vulnerability on the import side, which we have because of the higher cost of oil and commodities, because they're largely import dependent there. And I think we also have strong FDI as well. So I think this time around, if you look at our forex reserves, they are pretty strong, much stronger than they were, say, 2013 when the last taper tantrum happened. I would say they are backed by solid exports and FDI, and not so much. I mean, of course, there's an FII hot money element, but not as much as it was earlier. So I think we are not in an uncomfortable space over there. Obviously, we've got to watch it in case oil continues to reign in the $120 plus range for several months. Then it could be a problem. But I see that already cooling off with US slowing down, with China slowing down. So I think there will be a natural correction. And right now, I don't see a current account deficit as a major worry.
Right. And do you think that the government may miss this year's fiscal deficit target on the back of the inflation?
Well, I mean, I think if they cut if they are nudged into cutting fuel taxes more in a bid to rein in inflation, then you may have a problem on the fiscal numbers side. But I think at the moment, again, fiscal deficit is kind of intermediate indicator. In the end, what matters is how the economy is doing in terms of growth, inflation, and other indicators. So I think, even if it's off by a few marks, if it can rein in inflation, if cutting taxes on fuel can rein in inflation, then I think it'll be worth it, because otherwise you have runaway inflation and you respond by raising interest rates so high that you slow down the economy. So you may achieve a fiscal deficit of X% that you said, but you'll neither have growth at the level you want nor inflation at the level you want. So I think in that sense, I believe that a slight margin for exceeding the fiscal deficit is not bad if it can help control inflation in the circumstances.
Right. So on the fiscal deficit front as well, we had the recent report which came out and said that because the government revenues might take a hit, following cuts in excise duties on diesel and petrol, an upside risk to the budgeted level of gross fiscal deficit has emerged. So if that is the situation, how big a risk could that be?
No, I don't think, again, I think, again, all these risks, all relevant stakeholders and actors in the economy are seeing. We are going through a very unusual situation that we are coming off a first once in a century pandemic, and then you're followed by a war, which is also one of the most consequential in terms of the sanctions and the economic impact that we've had again in several decades. So I think the situation is extraordinary, and in extraordinary situations, you expect some amount of leeway to be given to the government on things like fiscal deficit. As I said, as long as it does not resort to careless spending of money, which it didn't even during the worst of the pandemic, I think it's all right. People will at this point appreciate inflation being reined in, because that's a far greater risk to the stability of the economy and growth of the economy than any marginal deviation from a fiscal deficit target.
Right. And overall, with all of this said and done, what's the impact you're looking at in terms of the bond yields as well as on the Indian rupee? Because clearly, there are a lot of estimates floating around that there's a possibility of a supply glut that could hit India's government bond market. And if that happens, where do you see the benchmark yields driving towards?
I mean, obviously, the yields are again going up, and if the situation on inflation is not arrested, and if the war continues as it is for several months, then obviously going to be an upward pressure on the bond yields and downward pressure on the rupee. But I think to some extent, again, I'm not that fearful at this particular point, because you can already see with news coming in about slowdown in the US and news from China and so on. There is a feeling that the inflation may cool down, expectation that inflation may cool down sooner than people might have otherwise expected, which will then put the pressure off interest rates and therefore bond yield and so on. But I think at the moment, if you ask me, even the interest rate hikes that the RBI did, the surprise one they did was more, I think, in the nature of protecting the rupee than immediately reining in inflation. Inflationary expectations, yes, and keeping the rupee stable. And I think volatility is more of a concern than the level. The level ultimately will be determined by the market, but you don't want too much volatility. And I think at the moment, obviously, hiking interest rates will be one way to contain that. But hopefully, I remain optimistic that over the next 6 months we will see inflation cooling off a little, with particularly because the monetary policy response now in the West, where the excess liquidity was created much more than here, that's being reversed. So that will cool off prices a little. The war, of course, is a continued uncertainty. But again, there also I see it's not really in the global economy's interest or anybody's interest to have oil prices above $100 a barrel for any length of time.
Right. And very lastly, in terms of credit growth as well, how are you viewing that aspect? Because that is crucial if you have to actually divide it between what's happening from the PSU side of it as well. Because the expectation was that, yes, there is growth coming in from the retail side. Private sector pickup is something which has slowed. It's not picked up to that extent it should have. What's your view?
So, again, I agree that private investment sentiment has not revived, and I think even the consumer or retail sentiment which had revived may dampen a little bit as uncertainties rise and inflation rise. People may may become reluctant to spend or borrow. But I think, again, for me, at least on the private investment side, I think there's a lot the government can do in terms of, ease of doing business. There are a number of sectors where, reform can be targeted. I think there's already a good policy out for electronics, for example. So I think we will certainly see, maybe not across the board, but we will see certain sectors which will see an upturn. Again, the interest rate cycle is not ideal, but I think, again, it's not reached the point where it's going to deter all investment. And globally, if you look at rates, they're still fairly cheap. You can still raise the money. I don't think money is the problem. I think creating the conditions for at least for investment purposes, consumption may be a different story. But for private investment, I think a few more reforms and a little more of ease of doing business will definitely help us.
Right. So overall, that's the sense that we're picking up. And anything else, that you think which are key highlights which we would have missed, which need to be considered and watched out for?
No, so I think obviously we are going through an extraordinary time, and I think what is happening in India vis-a-vis inflation in particular is not been caused by anything that has happened here. It's spillover of what is happening globally. So in that sense, there is only a limited amount we can do about it. When something is caused by external factors. So, but I think we are dealing with it, fairly well. People, of course, said the RBI was late, but I think RBI had to give and still has to give growth a chance in a country like India. You can't, not pay attention to that either. And I think difficult times require extraordinary responses. So I wouldn't be surprised if the government does one or two more unorthodox things, perhaps, as I said, even loosening the fist further and cutting taxes. But that is what is required. So I think let's not view this as a conventional inflation situation or a conventional overheat situation. It is not that. So the policy responses and the outcomes that we're going to get will be slightly different from what we would expect in an orthodox kind of conventional situation.
Right. So I think a lot of factors that will have to be considered from here on as well as to what happens. But thank you, Dhiraj, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.